It gives me real pleasure to introduce our first guest of the year, Neel Kashkari, President and CEO of the Federal Reserve Bank of Minneapolis. Neel has been the President and CEO of the Federal Reserve Bank of Minneapolis since January 1st of 2016, and he serves as a member on the Federal Open Market Committee, bringing the 9th Federal Reserve District's perspective to monetary policy discussions in Washington, D.C. In addition to those responsibilities, Neel oversees Minneapolis Fed operations and leads its many initiatives. And among them, he was instrumental in establishing the Opportunity and Inclusive Growth Institute, whose mission is to ensure that world-class research helps to improve the economic well-being of all Americans. Most recently, President Kashkari has joined with retired Minnesota Supreme Court Justice Alan Page to propose amending Minnesota's constitution to make quality public education a fundamental right. The word quality is the key word here. This effort supports the Fed's mandate to achieve maximum employment, with education being a key to obtaining a good job. Under Neel's leadership, the Minneapolis Fed also released an action plan on ending too big to fail, which calls for tighter bank regulations to avoid future taxpayer bailouts of large financial institutions. Neel earned his bachelor's degree and master's degree in mechanical engineering from the University of Illinois. He became an aerospace engineer, developing technology for NASA missions. Eventually turning to finance and public policy, he earned his MBA from the University of Pennsylvania's Wharton School, joined Goldman Sachs, and served in several senior positions in the U.S. Department of the Treasury, including overseeing the Troubled Asset Relief Program, or TARP, which you might remember from during the financial crisis. And before joining the Minneapolis Fed, he ran for governor of California in 2014 on a platform focused on economic opportunity. He lives with his wife, Christine, children Uli and Tecumseh, and Newfoundland dogs, Webster and Newsome, in Orono, Minnesota. Welcome, and thank you for being here today, President Kashkari.
Thank you, Bea. It is great to be with you. I really appreciate the invitation, and I really look forward to our discussion and our questions and answer session. And it's good to know for me that you're a closet economist, so I know we're going to have a very robust conversation and a lot of great questions. So let me just start by talking about why I'm here. Many people don't really understand what the Federal Reserve does or why there's a Minneapolis Fed. So the Federal Reserve is our nation's central bank. We were created by Congress, the US Congress, in 1913. And think of it this way, the basic job of the Fed is to manage the ups and downs of the US economy to try to achieve stable overall economic growth. But in 1913, the US Congress did something unique. They said they didn't want the central bank housed all in Washington, D.C. in the nation's capital. They wanted it distributed around the country. So they created the Board of Governors in Washington, which is a really important part of the central bank. But then they created 12 independent Federal Reserve banks, 12 of them, the 9th of which is here, the Minneapolis Fed. And our jobs are to represent this region in the nation's monetary policy making. And so what is this region? It's Minnesota, North and South Dakota, Montana, the Upper Peninsula of Michigan, and northwestern Wisconsin. So a lot of our time and a lot of our energy is spent traveling around the region, physically pre-COVID and now virtually, but hopefully soon back in person, to know what is happening on the ground in our regional and local economies, so that when I go back to Washington, D.C. every 6 weeks, again, pre-COVID, it was in person, right now it's virtual, but hopefully we'll be back in person soon. Part of what I'm doing in those meetings is talking about what's happening here in our regional economy. So meetings and discussions such as this are really helpful to me to hear directly from small businesses, mid-sized businesses, other businesses about what's happening, what are you seeing, what are the challenges that you're facing. So when I go back to Washington, D.C., I'm as informed as possible. Now, in Washington, at these Federal Open Market Committee meetings, we set monetary policy, or we set interest rates for the nation. Now, we cannot set a different interest rate for Minnesota and for California. We all use the same dollar. So we need to pick one interest rate, essentially, for the whole country. But we want all of the regions of the country as part of that deliberative process. And so that's really what my job is. There's more to it, but that's, in a nutshell, what a big part of my job is. And that's why meetings such as this are so important. Now, let me talk about 3 local issues that we spent some time on at the Minneapolis Fed, and Bea, you touched on one of them, just to let you know some of the things that we're working on locally. One is, as you know, the cities of Minneapolis and St. Paul have voted to increase their minimum wage over time. both cities have selected the Minneapolis Fed to do a long-term economic study of what is the effect? What actually happens to workers? What happens to their take-home pay? What happens to businesses? And analysis before this has been mixed. Some analysis has said, hey, this is great for workers. There are very few trade-offs. Other analysis has said, no, some workers benefit, but there are fewer jobs. And those who lose their jobs are obviously hurt by it. So what I'm excited about is that people across the state said, hey, we will trust the Minneapolis Fed to do this research honestly. And that's our commitment. The state legislature actually had to vote to change state law to give us access to data, very sensitive data, so that we could do this analysis. And it was bipartisan support because we committed we're going to do the analysis honestly. Now, just a couple months ago, we released the first installment of that analysis. It's an 8-year study, but even the first installment had some people unhappy because some people wanted to say there's no downside, there's no trade-offs. The analysis said, hey, it's a little more subtle than that. Actually, if you look at the restaurant industry in particular, there were job losses associated with this. So, we're not drawing firm conclusions yet. It's an 8-year study, but I wanted you all to know that we're committed to doing that work and doing it to the best of our ability without putting our finger on the scale. That's our contribution that we feel like we can make. And we're proud that Minneapolis and St. Paul both selected us to do this research. Second topic, just to mention, is after George Floyd was murdered in Minneapolis, my colleagues and I asked one another, what more could we do on the issue of racial equity and to try to make sure the economy is actually inclusive of everybody in our society. And I reached out to my colleague at the Atlanta Fed, Raphael Bostic. I reached out to him because Atlanta is also an epicenter for these issues just as much as the Twin Cities. And I said, is there something our two banks could do together? Well, we ended up launching what we call Racism in the Economy. It's a series of conferences examining racism throughout history and today in the labor market, in housing, in healthcare, in many, many facets of our economy. And we're so proud that all 12 Federal Reserve banks joined to partner in this work. And it's all of it's been online. It's all available on our website. It's there if you want to check it out. We had a session on the criminal justice system, and Attorney General Ellison was our keynote speaker at that event. It's a really robust series. If you're interested in these topics, I would just encourage you to go to our website, check it out. And in the next few months, we're going to be coming up with our capstone, kind of what we've concluded from this work. And then the third thing I would just mention is what you mentioned, B, that Minneapolis Fed has done work on education for a long time. This bank has done pioneering work on the value of investing in early childhood education because it's so important, especially for children from low-income families, that they get that jump early on. And now, as you mentioned, B, we're partnered with former Supreme Court Justice Alan Page to advocate for creating a civil right for every Minnesota child to receive a quality public education. And that work is ongoing. It's got strong bipartisan support, which again, we're very, very proud of. And so encourage you to learn more about it if it's something you're interested in. So let me just talk a little bit about the economy, and then B, I'm going to turn it over to you and we can have our discussion. We have at the Fed what we call our dual mandate. This is what Congress has told us that we are to achieve. One of which is stable prices, and we define that as 2% inflation year over year. And the other is maximum employment, as many Americans as possible gainfully employed and contributing to our economy. Now, we normally think that these two things are linked like a seesaw, that as the economy heats up and as businesses compete to find workers, you would see the unemployment rate go down. You would see wages go up as businesses work to find workers, and then that would lead to price increases and inflation. And so then in that scenario, historically, the Federal Reserve would raise rates to try to bring that seesaw into balance. Now, prior to the pandemic, year after year after year, we had this curious thing happening where businesses kept saying that they can't find workers. This is 2016, 2017, 2018. And the unemployment rate was dropping, but we weren't seeing strong wage growth, and we were not seeing high inflation. In fact, inflation was coming in below our 2% target. So in a sense, we were coming up short on both sides of our mandate. So in that environment, I argued that monetary policy was too tight. We're supposed to raise interest rates to balance out the seesaw, but if we're coming up short on both sides of it, that means we need to be more aggressive. So the economy was quite a good place, low inflation, low interest rates, low unemployment prior to the pandemic. Then obviously COVID hit in 2020, an unprecedented shock to the economy, unlike anything in our lifetimes. Rapid shutdowns, both because of government mandate, but also just because of individuals taking action to protect themselves. And now the economy has been recovering as vaccines have rolled out and we're getting to know the virus better. But the recovery has been uneven. One of the things that we saw when the economy shut down was that service industries were disproportionately affected. Think about restaurants, think about hairdressers, think about travel, hotels. So what did people do? They ended up shifting their spending towards goods. So one thing we saw was a lot of support from Congress to help families and to help businesses get through the COVID shock, help get through the shutdown. But we also saw families shift what they're spending on towards goods. So then we saw big goods inflation because there was this excess demand for goods. So you see a lot of stories about supply chains that have been disrupted, supply chains that are under stress. You see ports that are clogged. Part of that is because of COVID, and that's been affecting different sectors of the economy. Part of it is because there's been this excess demand for goods that would travel through those ports. So right now, we're obviously seeing very high inflation, much higher than we expected, much higher than I expected, and it has lasted longer than I expected. The key question that we're wrestling with is, how long is it going to last? On the demand side, we know how much money Congress has allocated to families and businesses in terms of stimulus. We know that. That's in law. We can analyze it. We know that that is temporary and that is now fading. So that boost of excess demand is going to go away unless Congress does something more, but I'm not expecting that. The question then is, when do supply chains start to recover? So a big area of uncertainty that we're focused on is, when are all the workers going to return? So the headline unemployment rate has fallen a lot. It's around 3.9%. Most of the time you'd say that's a really good labor market, but we're still 4 or 5 million jobs short of where we should be had there been no pandemic. So a big question mark that we've been very focused on is, where are those workers and what is it going to take to get them to come back in? When I was asked this question 6 to 9 months ago, I focused on a few things. I focused on, there were generous unemployment benefits that were being paid, that some people said, hey, these unemployment benefits exceed their pre-COVID income. That's a big disincentive to go back to work. Well, those have now expired. And we have not seen a meaningful uptick in labor supply just because those expired. I thought we would see, but we didn't. Another factor has been schools were closed much of last year. Now, obviously with Omicron, some schools are closed again this week, but generally speaking, schools are far more reopened than they were 9 months ago or last spring. So we thought that would help families go back to work. It's helped on the margin, but we've not seen this big uptick in labor supply. And I think a lot of people are still nervous about COVID, nervous about the variants that have come out, and are worried about going back into in-person service industries. So in terms of the supply side normalizing, the labor market's actually really important to understanding, when are we going to get back to full strength in our economy's potential? And that means putting as many of those folks back to work as possible. The last thing I'm going to mention, and then B, I'm going to turn it over to you for our discussion and our Q&A. I'm seeing a lot of churn in the labor market, which means a lot of people are shifting jobs. And I think they are shifting away from the toughest jobs. And I'll give you an example of what I mean by that. So one thing we hear from a lot of businesses, especially big businesses, is it's very hard for them to find long-haul truckers. It's easier to find local truckers than it is long-haul truckers. Well, I remember reading some comments from a union leader who represents long-haul truckers. And he was very stark in what he said. He said, stop complaining about trucker shortages. These jobs stink. These are really tough jobs. People are away from home for a week at a time. What do you expect? I mean, I'm paraphrasing his comments. But that actually resonates. I mean, if you could make decent money being a local trucker and sleep in your own bed, why wouldn't you? Another example of this is, if you look at the jobs and the labor reports, childcare workers are way down from where they were pre-pandemic. Well, childcare is a tough job. I've got two young children, a 1-year-old and 3-year-old. They're both in daycare. I have the utmost admiration for the folks who work in that daycare center. They work really hard. And if you look at the wages in childcare, they're not paid a lot of money. And one of the things we saw pre-pandemic was that home-based daycare operators in Minnesota were drying up. A lot of people were deciding to close their doors. What was going on? Well, I saw analysis that said, if you were a home-based daycare operator, your net take-home pay was below minimum wage, or maybe around minimum wage, because you got a lot of expenses to run that home daycare center. And as local businesses were paying more, as Target was paying $13 an hour or $14 an hour, people said, well, why am I going through this excruciating work when I could just go get a job at Target or Walmart or the equivalent, make more money, and just have much easier peace of mind than I have running this home daycare? So I think that's happening again today. As wages are going up in many sectors of the economy, I think you're seeing people say, hey, I'm going to choose to do something different. Not because I didn't like my last job, but that's a tough job. And you know what? I may have a higher quality of life and make more money in this other job. And so I think you're seeing this reallocation of workers away from what I will call some of the toughest jobs into more attractive jobs. And I mean, I'm really happy workers have choices. I want workers to have choices. But as the economy adjusts to this reallocation, I think that there are some strains that we are experiencing. So with that, I hope that was a good, helpful overview, B. I would love to get to our discussion.
Most excellent. So people start adding questions. I have several. Like I said, I follow you, and I was doing some writing earlier this year about hyperinflation. So my first question is, through 2021, we were watching prices rise, a lot of talk about hyperinflation. And you tempered concerns with the assurance that inflation would settle down with, and monetary policy changes would wait upon the stabilization of workforce, which you've mentioned here. Can you talk a little bit more about the hyperinflation threat and where we're at right now?
Sure. Inflation is, so we know that the drivers of high inflation right now, there's both a demand side, which I talked about. Congress put a lot of stimulus into the economy. And if you look at family savings rates, they've gone up across the board. Well-to-do people have saved more money, but low-income people have saved more money too. But we can analyze that, and it looks like the lower income parts of our society are spending down their savings because they have to. So that suggests that those folks will probably feel more pressure to go back and get jobs soon. So to the extent that people had more buffer saved up, they could be more selective in which job they take. As that money gets spent, they will likely have to go back into the workforce. So there's the demand side and the supply side. Supply side is everything from the trucker shortages that I talked about, the childcare shortages that I talked about. It's things like factories in Asia that can get shut down because there's a COVID outbreak, and then that affects global supply chains. There's also that rebalancing from services to goods, putting disproportionate pressure on our goods industries, on our manufacturers, et cetera. So it's a bunch of things happening at the same time, most of which should be temporary. Now, is temporary a few more months? Is temporary another year? I talked to a lot of large businesses with global supply chains, and I asked them, when do you think your supply chains are going to get back to normal? They tell me right now they're not getting better, that as they put out one fire over here, something else emerges over here in their global supply chain. So it's a constant game of whack-a-mole, so to speak. So when I asked them, when do you expect them to go back to normal? They would say, they're just guessing, not in 2022, maybe in 2023. I mean, that's just a guess. So, we don't know. But if you look at financial market indicators of where do financial markets think inflation is going over the long term, they're solidly in the camp that inflation is going back to historical levels of around 2%. So I don't overweight that. That's one data point that we pay attention to, but that at least gives us some confidence that a lot of sophisticated investors are looking at the same dynamics and saying this should be temporary and we should go back to a lower inflation environment in the future, but we have to watch the data. You're muted, B.
Thank you. Thank you for that. Fascinating. Here's another question for you. Labor is difficult to find in many industries as people shift and more people want remote work. Uncertain how that will change. How do you think automation in many sectors will impact the future of work and employment?
Well, I mean, automation, it's kind of a one-way street. You know, we just keep adding it as pressure built. And a lot of businesses say, we can't find workers. We have no choice but to invest in automation. So net, I think that's good for the economy. I think it's disruptive while those technologies are being adopted. So as an example, I have not been traveling in the last 2 years. I mean, I've visited family, but I don't believe I've stayed in a hotel in 2 years. I've heard from some hotel operators that, yeah, virtually all check-ins are now automatic. There's a kiosk, you go, you put your ID and you put your credit card in, and they're saying, we don't see that going back. You know, why did they do that? They did that because they had to, because they couldn't get the hotel workers that they needed. So I think things like that are probably here to stay, which ultimately will make the economy more efficient, but it's going to be an adjustment for all of us to get through it. You know, think about a video conferencing. You know, I'd never used Zoom prior to the pandemic hitting. And I think that, will I now travel a little bit less because some of these meetings that I used to go in person for, we can do remotely? Probably. That's probably a good thing. Probably be more efficient as a result. I think a lot of this we are going to learn by doing, and we're going to experiment, and we're going to learn from one another. Just the whole notion of hybrid work. I think early on people said, oh, the future is all remote. You know, you stop and think about it. How do you develop young people? How do you mentor? Can you do that over Zoom? Right. I personally think things are lost if you're simply remote. And so we are at the Minneapolis Fed have said, we're going to do kind of a hybrid model, give people more flexibility, but we still expect people to be back in our facilities a majority of the time. And so I think we're all going to learn from each other about what makes the most sense in the future.
Well, and I really appreciate your comment about automation is actually a response to the workforce environment. You know, early on, there was a lot of fear that it would take jobs, when the truth is it's in the response to the lack of people to do the jobs. So I really am in alignment when you're thinking about that. Here's a question. Have you reviewed or are you familiar with the bank merger proposal that members of the FDIC board tried to add to the agenda in December? Specifically, I'm curious how you believe the banking industry will be impacted by this proposal. It's my understanding that the proposal will impact rules on climate change risk, cryptocurrency, and fair lending, as well as potential mergers.
So I'm aware that such a proposal was put forward and that there was a lot of press attention around it and some controversy around it. I have not looked at the proposal, so I apologize. I can't comment on it just because I haven't read it and I don't know what's in it.
No problem. No problem. Fair. All right. For this question, I'm personally in line with this. I'm considering, building a house this year. So I'm very interested in the housing market and interest rates. And you had recently published perhaps some adjustment in 2022. So this specific question is, can you speak about the market rate housing market and what you think are the biggest factors to watch heading into this year?
Well, we know one of the ways that monetary policy affects the economy is through the housing market. That's one of the primary channels. So, we move an overnight interest rate called the federal funds rate up and down as our primary policy tool. But that really has an effect on long-term interest rates. And that's how we affect the economy. So if we move the federal funds rate up, one might expect the long-term rates to go up with that. It's going to depend on a bunch of factors, but let's just say long-term rates go up. That will, on the margin, make the cost of a mortgage more expensive. And that will then cool down the housing market, at least on the margin, somewhat. So I think we have a lot of effect on the housing market. The housing market has obviously been very strong in the last several years. But I think mortgage interest rates are still at very low rates, even though we've signaled that we are going to stop our quantitative easing program pretty quickly, that we've signaled that rate increases are likely in the horizon. Mortgage rates are still at quite low levels. Mm-hmm. A big question mark, and this is complicated, but just bear with me for a moment. A big important factor is what interest rate is neutral for the economy.
Yeah.
What interest rate neither stimulates the economy nor restrains the economy? Well, it turns out that that neutral rate changes over time, and it's been declining over the last 20 or 30 years to very low levels. So what we do is we try to estimate where that neutral rate is, and then we decide whether we want to provide some boost to the economy, then we'll go below neutral to provide stimulus, or if we want to tap the brakes, we would raise interest rates above neutral to tap the brakes. But that neutral rate is not set by us. That neutral rate is set by broader economic forces like demographics, the aging of our society, like trade and technology. The reason I'm telling you all that is that some people say, well, why are interest rates back where I remember them 20 years ago, or 30 years ago, or 40 years ago? And I would tell them, my response would be, because the neutral rate has come down so much that we are not likely going to go back to those type of interest rates, because that would be crushing for the economy. Rather, if we need to tap the brakes, we will go to neutral or get to somewhat above neutral, but neutral is now down here when it used to be up here. That's why I think that you expect to see mortgage interest rates still being fairly attractive for the foreseeable future.
Great. Thank you. Here's another question I've been really interested in. Cryptocurrency and Bitcoins. I don't even know if they're connected or if they're the same thing. Can you introduce us to cryptocurrency, Bitcoin, and how are they? They're kind of a thing. They're impacting financial markets. How is the Fed approaching them short-term and long-term?
Well, there's I don't know how much time we have. So what is it? And I'm sure the Bitcoin enthusiasts who are watching this are going to criticize me for not characterizing it correctly, and that's fine. It's an electronic currency, the instrument that has been created in the across computers around the world, and it's all independently run by this network of computers all around the world. So the enthusiasts like it because there's no government controlling it. The enthusiasts like it because they say, hey, by design, by the algorithm itself, there can only be so many Bitcoin ever created. So you're never going to see high inflation because there's no ability for anybody to say, hey, I'm just going to go print more Bitcoin. That's the attractiveness that the enthusiasts will talk about. So that sounds pretty good. Now, the problem is there's no barrier to you creating Bitcoin and to me creating Neel Coin and everyone on the screen creating their own version of Bitcoin or cryptocurrency. So if you go back in American history, there was a time when every state had its own currency. There was a time when individual banks had their own currency, and it was chaos. And so you could say, well, my state is really fiscally prudent, but it's still chaos if all the other states around you are not fiscally prudent. Mm-hmm. And so the Achilles heel of cryptocurrency, from what I can tell, is that there's no barrier to entry to people creating many of these new things. And there have literally been thousands of these coins created. People have been fleeced out of tens of billions of dollars in pump and dump schemes, chasing these what are basically garbage coins. And so I am not ruling out the possibility that something useful could come out of the sector. It is possible that this innovation leads to something useful, but I'm waiting for anybody to explain to me what that is. Mm-hmm. And I'm looking for it. So the Federal Reserve is studying this because some people have said, hey, the Fed should issue its own Fed coin. And the Federal Reserve is doing some analysis of what the pros and cons would be, and are going to be issuing a white paper soon, giving some initial thoughts on that.
Very interesting. I look forward to that. Really, you hear, especially my kids talk about Bitcoin, and I'm thinking, well, then it's so appreciate that. I look forward to reading that white paper. And speaking of printing money, we can't escape the question, and I really look forward to your answer, that the Fed essentially printed 300 years worth of money in 2 short months during the COVID response. That statement has been made. How do you respond to that when you hear that?
You know, the original role of central banks, not just the Fed, the Bank of England, the Bank of Canada, the European Central Bank, the original role of the creation of central banks was to be what we call the lender of last resort. When something hits the economy and everybody panics and people say, I just want cash, Before central banks existed, you know what happened? They all ran to their bank, they withdrew whatever money they could, but those banks had made loans, mortgages and business loans. They couldn't return the money to their depositors, and those banks all failed.
Right.
And you saw widespread banking failures littered throughout American history before the creation of the Federal Reserve. So in a moment of intense fear, when everybody just wants cash, the job of the central bank at that point is to step in and lend dollars widely against good collateral. And that's essentially what the Federal Reserve did when the COVID shock happened. I mean, at that moment, people were shutting not just stocks and corporate bonds, but people were shutting treasury bonds. Usually people buy treasury bonds when they get scared. In that moment, nobody knew what was going to happen. They were shutting everything. And we were seeing the financial markets facing the risk of a collapse. We also saw local banks would report to me, hey, we have customers calling us up wanting to withdraw all their cash. And so they would then come to us and we would lend them money so that they could calm everybody down and meet their customers' needs. So that is an acute example of, in a moment of financial panic, the central bank stepping in to flood the money, to flood the system with cash. And that's essentially what the Federal Reserve did through a lot of different programs to make sure everybody was confident that they could get their own money back if they needed, if they really needed it. And it was very effective. It calmed things down. You know, I'll give you one more example on this, why it was so important. We saw sectors of the economy when the COVID shock hit that were terribly disrupted. Airlines, hotels, as an example. We also saw sectors of the economy that did great. Think about the food producers like General Mills. Like all of us stopped going out to restaurants. We started buying in the grocery store a lot more. So General Mills was doing great. But imagine if financial markets had collapsed so that good companies whose businesses were doing great, like General Mills, if they could not go to the financial markets and raise the money that they needed for their operations, then this COVID crisis that was hitting certain parts of the economy would now spill over and hit the whole economy. That's why it was so important for us to step in to get financial markets moving again so that the crisis did not become even deeper and even broader than it needed to be. And so, yes, we put a lot of money out in the economy at that time. We lent it against everything from treasury bonds to mortgage bonds to corporate bonds. And we haven't lost any money. And we are now in the process of beginning the steps to unwind. We've unwound some of those programs. We're now in the process of slowing that down and unwinding the rest of those programs in a gradual, measured way over time. And I'm absolutely proud of the actions the Federal Reserve took at the time of crisis. It was the right thing to do, and it absolutely supported the U.S. economy.
How did it impact the national debt? Did it short-term and or long-term?
No, not the Fed's actions don't. So this is the distinction between monetary policy and fiscal policy. Yes, when the U.S. Congress decided to pass various COVID relief bills, like the CARES Act, as an example, they then went to financial markets and borrowed money to fund putting money in businesses' hands and in families' hands. That affects the national debt. What the Fed is doing, that's fiscal policy. Monetary policy is we're just putting out dollars in exchange for safe assets like treasury bonds or like Fannie and Freddie mortgage-backed securities, as an example. That is not affecting the position of the national debt. That is potentially affecting inflation, right? If we do too much of that, that can be a contributor to inflation. And that's why we've accelerated what we call the taper of our quantitative easing program to put us in a position to withdraw some of that support more quickly if we need to make sure that we keep inflation in check.
So another question about how Minnesota's economy managed these last 2 years. I'm sure you're aware of the book, The Headquarters Economy, written by Miles Schaefer out of the University of Minnesota, trying to figure out why do we have so many Fortune 500s. He did a lot of research on the diversity of our economy, how that makes us more resilient. What were some of your observations about the 9th District in terms of how it responded to this economic crisis relative to the entire country?
Well, I think what you said is right, which is the diversity of the economy really supports Minnesota's overall economic resiliency. When I think about Minnesota's economy, it's like a little mini United States because most major sectors of the US economy are here at reasonable scale. So if the ag sector is getting hit nationally, it's probably getting hit here locally. If manufacturing is doing well nationally, it's probably doing well here locally. We have manufacturers in Minnesota that sell around the country, but we have manufacturers in Minnesota that sell around the world. We have manufacturers in Minnesota with local supply chains. We have manufacturers in Minnesota with global supply chains. So in many ways, everything that we looked at nationally, we saw just about everything happening here locally. Now, one thing that was maybe a little bit different is just the waves that we saw of COVID were quite regional. The Southeast was getting hit at a different time than the Northeast. The Upper Peninsula or the Upper Great Plains were getting hit at a different time. So that was a little bit different. When we would get the COVID waves was somewhat different than other parts. That was really just based on geography. But other than that, I thought Minnesota really reflected the strengths, but also the challenges that the U.S. economy faced in this 2-year period.
Thank you for that. The Fed, here's another question. The Fed has a unique power to reshape the American economy. How has the Fed leaned into criticisms that monetary policy over the last 10 years has accelerated income inequality? And what is the Minneapolis Fed doing in that space?
Well, first thing let me mention is, you mentioned this in your introduction to me. 3 or 4 years ago, we started the Opportunity Inclusive Growth Institute. So when I got to Minnesota, I moved here six plus years ago. I was surprised to discover that, Minnesota has a lot of strengths, but I was surprised to discover that we have some of the biggest economic disparities in the country, racial disparities, but also low income, like rural communities versus the cities, and middle class communities. And I wanted to understand why these gaps exist and what has been done about them. What can we learn from other places? And a lot of questions I asked, I got very few good answers. And so I said, we need to spend a lot more time having a focused research program to understand these issues, to try to get to an economy that's much more inclusive. So we launched the Opportunity Inclusive Growth Institute, and that's a long-term research center focusing on these issues of income inequality and income and economic disparities. So that's answering the question of what we're trying to do about it. To the point of, has monetary policy expanded income inequality? I think we need to make a subtle distinction between income inequality and wealth inequality. So a lot of people will say, well, the Feds have this aggressive monetary policy. It is supported the stock market, and the stock market is disproportionately owned by higher income folks. I think there's some truth to that. Who owns stocks? It's higher income folks. And to the extent that the Fed has supported higher stock prices, that has probably expanded on the margin wealth inequality. But there's a counterpoint to that, income inequality. For most Americans, the most valuable asset they have is not a house, if they even own a home. The most valuable asset they have is their job. And you think about it, somebody makes $30,000 a year. What's the value of a job that makes $30,000 a year? If you just do some very simple financial calculations, at a 10% interest rate, that's equivalent to about a $300,000 asset. At a 1% interest rate, that's a $3 million asset. The value of jobs are profoundly valuable to families, especially to the lowest income families. So what I believe we've been doing with our approach to monetary policy, I talked about the dual mandate. So prior to the pandemic, we were coming up short on our inflation target, and there were more and more Americans who wanted to work. We were trying to have as tight a labor market as we could to put as many Americans back to work and help their wages go up until we got back up to our 2% inflation target. So I would argue, if you looked at the data, by the way, the biggest benefits in wage gains prior to the pandemic and since, by the way, were to the lowest income workers. These are folks who are long, long overdue for a raise. So I hear these arguments. I think our policies have really been focused on trying to help the lowest income folks get a better job, get better wages. And I simply say to folks, if you say, well, we got to clamp down on Wall Street, clamp down on the stock market. If we raise interest rates to say we're going to clamp down on the stock market, who's going to bear the brunt of that? If the brunt of that is going to be borne by the lower income workers who now don't have the wage gains that they deserve, who now don't have jobs, boy, that's a really costly exercise. And so we have to be monetary policy is this blunt instrument And oftentimes when I hear this criticism, I mean, I'm sympathetic with the spirit behind it. But as I think through the steps, it's not at all clear that monetary policy is the right tool to address some of the wealth inequality that we see in our country.
That's an interesting point. You know, after the Great Recession, I tracked all of this, you know, our slow, grinding recovery after 2008 and 9. And I mean, it was progress, but it was so grindingly slow, shockingly, historically slow in terms of the pace of recovery. And wages did not increase in a way that we would have anticipated after the Great Recession. Are you seeing, and so at the time, economists were talking about kind of a new normal of recovery, that there wasn't a great increase in wages despite the recovery that we were struggling through. Are you seeing wage increases behaving more normally this time? Or are you kind of feeling echoes back to the Great Recession?
Well, we are seeing higher wage increases now, and that gives us some, since I've been at the Minneapolis Fed now for 6 years, I've heard businesses tell me they can't find workers. There's a worker shortage. All right. One of the things I've learned is that if businesses they don't put a help wanted sign up, and they don't have a line of qualified workers down the street, they declare a worker shortage. So I've heard this for years, and I'm not sympathetic anymore with that just because I've heard it so much. Having said that, a lot of data we look at today does suggest that there's an imbalance, that the demand for workers is exceeding the supply of workers, and that the recovery in demand for workers in this COVID recovery has exceeded the recovery in the supply of workers. The demand has exceeded. So I'm more sympathetic now that there is that mismatch. And one piece of data that's evidence of that is that wages are climbing across the board. Mm-hmm. They're climbing most quickly for the lowest income workers, but they are climbing across the board. And we didn't see much of that in the prior recovery. That's how I kind of knew that businesses were just whining. Like I always ask businesses, you say you can't find workers, are you paying more? No. Well, then you're just whining. Now they're
I kind of wondered about that last time. Yeah, right.
Yeah. Now they're actually paying more. And so now I take these complaints much more seriously because I do think it's showing up in the data.
Yeah, I'm hearing that a lot, just colloquially. Companies are, if this is an employee empowered market right now, where particularly when remote work, people are being courted by companies outside of this region to work because they can, and prices are shifting and rates are shifting, interestingly. Okay.
But, can I just add one more thing?
Yeah.
We all have anecdotes. So there's a convenience store near my house, a gas station that I go to, and I chat with the proprietor. He owns 5 convenience stores, gas stations around the Twin Cities, been in this business for 20 or 30 years. And he has a help wanted sign up. So I asked him, I said, what's it like trying to find workers? He said, he's shaking his head. He's never seen anything like this before. It's just unprecedented how there's a worker shortage now. He has not experienced it in 30 years. I said, what is it normally like? He said, normally I put the help wanted sign up and I have people lined up outside qualified to pick from. All right. And now it goes days before he has an applicant. Well, my question for all of us, why is that what he experienced historically? Why is that normal? Does that strike you as an imbalance? That normal, what we consider normal, is you put a help wanted sign up and people are lined up down the street? That strikes me as the pendulum having skewed too far toward business and away from workers. Now, maybe the pendulum has gone too far the other direction, but I'm not in the camp of we need to get back to where it was. That doesn't feel like a sustainable economy to me.
Fascinating. Thank you. So it's prepping for today. I opened up the news this morning, and there's I have to ask you about the headlines today. National Review talked about the U.S. Bureau of Labor Statistics announcement on Friday that inflation over the last 12 months increased at the fastest rate in 40 years, since 1982, exceeding expectations, even expectations. Natural gas now is at a 15-year high price point. So where was this real explosion of inflation? Where did you see it most seen? And give us some context.
Yeah, it is most seen in some of those goods sectors that I talked about, where people shifted away from services towards goods, and they had more money in their pockets. And so all of a sudden we're buying, remember 2 years ago, all of a sudden there was a shortage of bicycles. You couldn't get bicycles. Everybody was running and buying bicycles, and then the supply chains couldn't keep up. That's just one example of that. So we've seen the most the largest price increases in those goods sectors, and especially in some of the sectors that are global. You know, think about cars. The market for cars is a global market. The market for many commodities are global markets. So if there's stimulus in America, it can affect prices globally. If there's stimulus in Europe, it can affect prices of those goods globally. So a lot of those global markets that are globally, shipped goods, we've seen the biggest increases, not exclusively. Obviously, housing is a local market. We've seen home prices increase across the country, but the biggest increases have been in some of those goods markets related to the pandemic.
Very much makes sense. Well, I'm sorry, we're running. I just looked at the clock and went, oh, we're running out of time. So I just can say thank you for the courtesy of your time. I just really appreciate your thoughtful approach, to the work that you do and your willingness to share that with us. So I know I'm speaking for everybody here, and we had almost 90 people registered just to come hear you speak today. So thank you for the courtesy and much appreciated. Good luck as you face a really challenging year ahead.
Thank you. I really appreciate the invitation and look forward to meeting with all of you in person, hopefully soon.